silver market just broke in ways most investors don't understand. Silver prices surpassing $106 isn't normal appreciation. This represents complete breakdown of market structure and mechanisms. What we're witnessing isn't typical bull market behavior. Price discovery systems have completely failed across multiple venues. The relationship between paper contracts and physical metal collapsed. Market makers cannot provide orderly pricing anymore. The COMEX silver market shows unprecedented stress signals. Physical deliveries exceed warehouse inventories by alarming margins. Contract holders demand actual metal delivery increasingly. Exchange officials cannot satisfy delivery requests adequately. Registered silver inventories at COMEX warehouses hit critically low levels. Available metal for delivery dropped below 30 million ounces. This represents less than 4 days of normal demand. Industrial users compete for remaining supplies desperately. The spread between paper silver and physical metal widened explosively. COMEX futures trade at significant discounts to spot. Physical dealers charge premiums exceeding $20 per ounce. This disconnect signals complete market structure failure. London Bullion Market Association faces similar delivery pressures. Vault inventories decline despite higher prices, attracting sellers. Large institutional buyers remove metal from circulation permanently. Available supplies shrink faster than production can replace. Regional markets show even more extreme dislocations currently. Asian physical markets trade at massive premiums. European dealers report inventory shortages across product lines. North American coin dealers face unprecedented supply constraints. The velocity of price movements caught everyone unprepared. Silver moved from $32 to $106. This happened in less than 8 weeks. Normal market mechanisms cannot handle this acceleration. Technical analysis becomes meaningless during structural breakdowns like this. Support and resistance levels provide no guidance. Moving averages cannot predict parabolic price movements. Chart patterns break down during supply shortages. Volume patterns reveal the nature of current buying. Physical accumulation dominates trading activity increasingly. Speculative trading represents minimal market participation currently. Industrial users drive most demand through necessity. Market makers withdraw from providing liquidity during extreme conditions. Banks reduce position limits to manage risk exposure. Hedge funds avoid silver markets due to volatility. Traditional arbitrage mechanisms stop functioning properly. The paper market cannot deliver physical metal adequately. Futures contracts become cash settlement by necessity. Exchange rules change to prevent delivery defaults. Contract specifications modify to reduce physical obligations. Industrial demand creates the foundation for current price explosion. Solar panel manufacturing requires massive silver quantities annually. Electric vehicle production consumes increasing amounts per unit. Electronics manufacturing cannot substitute alternative materials easily. Defense applications drive inelastic demand for silver consistently. Military electronics depend on silver's conductivity properties completely. Missile guidance systems require silver components for reliability. Electronic warfare capabilities consume substantial quantities regularly. Medical sector demand continues growing despite economic uncertainty. Antimicrobial applications make silver irreplaceable in healthcare settings. Surgical instruments require silver coatings for infection control. Wound care products depend on silver's healing properties. The supply side faces constraints that amplify scarcity. Primary silver mines produce only 30% annually. Byproduct production from base metals provides remaining supply. Copper and lead mining cutbacks reduce silver automatically. Environmental regulations restrict new mine development significantly worldwide. Permitting processes take years even for proven deposits. Local opposition delays project implementations consistently. Operating costs increase faster than revenue growth. Existing mines face declining ore grades over time. Processing requires more energy per ounce extracted. Water usage restrictions limit production capacity regionally. Labor shortages affect mining operations globally. Recycling cannot match industrial consumption growth rates currently. Electronic waste processing requires expensive specialized facilities. Silver recovery rates from electronics remain relatively low. Collection and processing costs often exceed metal values. The mathematics create inevitable shortages during demand surges. Annual global production equals approximately 800 million ounces. Industrial consumption absorbs over 600 million ounces. Investment demand during panics can exceed available supplies. Central banks inadvertently support silver through monetary policies. Money printing creates inflation expectations among investors. Currency debasement drives demand for tangible assets. Real interest rates remain negative despite headline rates. The Federal Reserve faces impossible choices regarding monetary policy. Raise rates and crash over-leveraged debt markets completely. Keep rates low and accelerate currency debasement permanently. Either path supports precious metals, demand structurally. European central bank policies create similar precious metal support. Quantitative easing programs continue despite inflation concerns. Negative real yields make hard assets attractive. Currency instability drives European silver demand increasingly. Bank of Japan maintains extremely accommodative monetary policy. Their bond purchases exceed government issuance regularly. Yen debasement accelerates through currency intervention costs. Japanese investors seek alternatives to domestic assets. These central bank policies destroy confidence in currencies. Savers face guaranteed purchasing power losses consistently. Bondholders experience negative real returns permanently. Physical assets provide the only reliable value storage. International developments accelerate silver demand through multiple channels. BRICS nations develop commodity-based payment systems actively. Gold and silver gain monetary usage internationally. Alternative currencies reduce dollar demand systematically. China promotes gold and silver in international trade. Their Belt and Road Initiative includes precious metals. Chinese investors access silver through expanding market mechanisms. Industrial demand grows with manufacturing expansion plans. Russia maintains large precious metals reserves despite sanctions. They accept gold and silver for energy exports. Sanctions accelerate alternative payment system development. Physical assets provide sanctions-resistant value storage internationally. Geopolitical tensions increase strategic metal hoarding behaviors globally. Supply chain security becomes national priority increasingly. Critical materials stockpiling includes precious metals systematically. Resource nationalism restricts exports during shortages. The technological revolution requires unprecedented silver quantities. Artificial intelligence systems need silver-containing semiconductors extensively. Data centers require massive electrical infrastructure using silver. Internet expansion consumes increasing electronic component quantities. 5G network deployment accelerates silver demand through infrastructure requirements. Internet of Things devices multiply electronics usage exponentially. Smart city initiatives consume massive industrial metal quantities. Connectivity expansion requires silver-intensive electronic components. Space exploration and satellite technology increase silver demand. Military modernization programs consume increasing precious metal quantities. Defense spending includes strategic material stockpiling programs. Technological competition drives resource accumulation behaviors internationally. Electric vehicle infrastructure expansion requires massive silver quantities. Charging networks need substantial electrical system installations. Battery technology improvements may increase silver content. Transportation electrification represents permanent demand growth. Renewable energy transition policies accelerate silver consumption exponentially. Solar panel installations require massive silver quantities annually. Wind energy systems use significant silver in components. Grid modernization demands silver-intensive electrical infrastructure extensively. Energy storage systems require silver for battery applications. Grid stabilization technology uses silver in electronic components. Smart grid development consumes unprecedented silver quantities. Energy independence policies drive domestic renewable investment. The financial system's stress supports precious metals systematically. Banking sector faces commercial real estate exposure risks. Insurance companies struggle with bond portfolio losses. Pension funds cannot meet obligations through traditional returns. Corporate debt levels approach unsustainable ratios across sectors. Consumer debt burdens reach historical peaks globally. Government debt service consumes increasing budget portions. Credit market stress spreads beyond immediate headlines. Regional bank failures demonstrate system fragility increasing continuously. Deposit flight accelerates during confidence crises rapidly. Federal Reserve interventions cannot prevent all failures. Banking consolidation removes smaller institution competitors systematically. These financial stress factors drive silver demand defensively. Portfolio diversification requires hard asset exposure increasingly. Wealth preservation becomes priority over return generation. Physical assets provide security during system instability. Modern monetary theory. Implementation creates permanent inflation bias. Government spending increases without traditional funding constraints. Debt monetization becomes explicit policy rather than emergency. Currency debasement accelerates through direct money creation. The investment landscape transforms through inflation persistence patterns. Traditional portfolio allocations fail during stagflation periods. Real assets outperform financial claims during debasement. Commodity exposure becomes essential diversification component necessarily. Demographic factors amplify precious metals demand significantly currently. Baby boomers seek wealth preservation, approaching retirement. Millennials face asset inflation beyond income growth. Generational wealth transfer favors tangible asset preservation. Exchange-traded fund silver holdings remove metal from circulation. Physical backing requirements create additional demand sources. Fund inflows compete with industrial users for supplies. ETF popularity democratizes precious metals. Investment access. Cryptocurrency wealth rotation supports precious metals demand indirectly. Digital asset profits often move into physical assets. Blockchain technology enables fractional precious metals ownership. Crypto volatility demonstrates hard asset stability comparatively. The manufacturing sector faces permanent supply chain transformation. Just-in-time inventory models prove inadequate during disruptions. Strategic stockpiling becomes necessary for production security. Industrial hoarding increases metal demand beyond consumption. Globalization reversal through reshoring creates additional silver demand. Domestic production requires local supply chain development. Critical material security becomes national economic priority. Resource localization increases regional demand substantially. Climate policies mandate massive infrastructure investment using silver. Carbon reduction targets require unprecedented renewable deployment. Green technology implementation consumes enormous silver quantities. Environmental regulations simultaneously restrict mining expansion significantly. The shipping and logistics sectors face persistent disruption. Container costs remain elevated, affecting global trade. Supply chain delays force inventory building behaviors. Transportation constraints increase regional price disparities. Labor shortages affect mining operations across multiple jurisdictions. Skilled worker availability limits production capacity expansion. Wage inflation increases operating costs faster than revenues. Automation requires massive capital investment over time. Energy costs impact mining profitability significantly and consistently. Electricity-intensive processing faces rising power prices. Fuel costs for transportation and equipment operation increase. Carbon taxes add expenses to traditional mining operations. Water usage restrictions limit mining capacity in regions. Environmental compliance costs increase operating expenses continuously. Waste management requirements add complexity and costs. Community relations require ongoing investment and attention. The regulatory environment becomes increasingly restrictive toward mining. Environmental impact assessments take longer to complete. Permitting processes face political opposition regularly. Operating licenses require continuous compliance and monitoring. International trade tensions affect silver market dynamics significantly. Tariffs increase costs for cross-border metal movement. Export restrictions limit supply availability regionally. Trade agreements influence metal flow patterns globally. Currency volatility complicates international silver trading extensively. Exchange rate fluctuations affect pricing and profitability. Hedging costs increase transaction expenses for traders. Settlement risks rise during currency instability periods. The derivatives market cannot function properly during shortages. Options pricing models break down during parabolic moves. Futures curves invert, reflecting immediate supply constraints. Margin requirements increase, reducing speculative participation significantly. Market manipulation becomes impossible during genuine shortages. Large position holders cannot suppress prices through selling. Physical demand overwhelms paper market control mechanisms. Price discovery shifts from exchanges to physical markets. Storage and insurance costs increase during extreme volatility. Vault space becomes premium commodity during accumulation phases. Security requirements increase with higher metal values. Insurance premiums rise with replacement cost increases. Transaction costs rise throughout the supply chain systematically. Dealers increase spreads to manage inventory risks. Shipping costs escalate with insurance and security requirements. Processing delays create opportunity costs for participants. The retail market faces unprecedented supply constraints currently. Coin and bar production cannot match demand levels. Waiting lists develop for popular physical products. Premium levels reach historically unprecedented ranges regularly. Institutional demand competes directly with retail buyers. Pension funds seek alternative asset allocations increasingly. Sovereign wealth funds diversify from traditional investments. Corporate treasuries consider precious metals for reserves. The silver market breakdown represents structural rather than cyclical change. Supply and demand imbalances cannot resolve through pricing. Industrial necessity prevents demand destruction completely. Investment demand accelerates during monetary system stress. Recovery to normal market function requires supply expansion. New mine development takes years even when profitable. Existing operations cannot increase output rapidly significantly. Recycling expansion faces technological and economic constraints. Alternatively, demand destruction through economic recession might rebalance markets. Industrial silver usage correlates with manufacturing activity generally. Economic slowdown would reduce consumption temporarily only. Investment demand might increase during recession fears. Price volatility will continue until structural imbalances resolve. Higher prices encourage supply development over time. Demand substitution occurs only at extreme price levels. Market structure repairs require years of adjustment. The current silver explosion reflects forced rather than speculative demand. Industrial users cannot postpone silver purchases indefinitely. Electronic device production requires silver regardless of price. Energy infrastructure development cannot substitute alternatives easily. Understanding these dynamics requires recognizing supply chain realities. Silver performs essential functions in modern technology. Alternative materials cannot replicate silver's properties exactly. Industrial civilization depends on silver availability fundamentally. The breakdown in silver market mechanics represents system failure. Paper contracts cannot deliver physical metal adequately. Price discovery mechanisms cannot function during shortages. Traditional market relationships dissolve under extreme stress. Higher and sharper price fluctuations become inevitable mathematically. Supply cannot increase rapidly to meet demand. Industrial necessity prevents significant demand reduction currently. Investment panic accelerates price movements beyond fundamentals. The silver market entered uncharted territory beyond historical precedents. Previous bull markets occurred during different economic conditions. Current industrial applications didn't exist in earlier periods. Modern financial systems create unique vulnerability patterns. Recognition of these structural changes enables appropriate positioning. Physical silver ownership becomes essential during breakdowns. Paper claims provide inadequate protection during delivery failures. Storage and security become critical portfolio considerations. The silver explosion signals broader monetary system transformation. Currency debasement drives hard asset demand systematically. Financial system instability supports precious metals fundamentally. Economic uncertainty favors tangible wealth preservation methods. This process continues regardless of short-term corrections. Market structure breakdown cannot reverse quickly easily. Industrial demand provides permanent price floor support. Monetary conditions support continued precious metals appreciation. The mechanics broke because reality exceeded paper market capacity. Physical silver scarcity overwhelmed futures contract obligations completely. Delivery demands exceeded available inventory supplies significantly. Price discovery shifted from derivatives to spot markets. Understanding this breakdown explains future price behavior patterns. Volatility increases when markets cannot clear normally. Premiums expand when supply cannot meet demand. Price gaps occur when normal arbitrage fails. The silver market will remain broken until equilibrium restores. This requires either massive supply increases or demand destruction. Neither outcome appears likely in current economic environment. Market dysfunction continues supporting explosive price movements.